We warned you this would happen. Not because we're dramatic, but because this is what the system does when it starts to lose control. It doesn't admit defeat, it changes the rules. And the moment silver started leaning into the mid-80s, you could feel the temperature in the room shift. That's not volatility. That's pressure. That's short exposure getting uncomfortable. That's the kind of move that forces people in risk rooms to pick up the phone. Here's what matters. When the wrong side of the trade is in trouble, the market doesn't always discover a price. Sometimes it gets managed, quietly, politely, in the language of compliance. No sirens, no breaking news banner, just a notice that reads like paperwork, until you translate it into consequences. Today, Tuesday, January 13, 2026. While most people were staring at a silver chart trying to figure out if $86 was about to break, the Chicago Mercantile Exchange quietly dropped an emergency advisory. Not a rumor, not a tweet, an official notice. And if you know what to look for, this is the kind of move that only shows up when someone is trying to stop a train without telling the passengers the brakes are failing. Because that's the trick. They don't have to ban anything. They don't have to say the word control. They just adjust the plumbing, margin rules, collateral requirements, the cost of staying long, so the selling looks voluntary when it isn't. It's forced, it's mechanical, and it hits hardest at the exact moment momentum gets dangerous. So the question isn't whether silver is strong. The question is why the rule change had to happen right then, and what it tells you about what's actually happening behind the price you see on your screen. The markets look quiet until you realize the silence is staged. One print on the screen, one number, and behind it, a room full of people who can't afford to let that number keep climbing. Because when silver pushes into the mid-80s, it stops being a trade and starts becoming a threat, an exposure problem, a margin problem, a credibility problem. This is where the broadcast begins, not with hype, but with a warning. If you think you're watching normal volatility, you're already playing the wrong game. What you're looking at is a controlled arena, rules, referees, and a scoreboard that can be adjusted the moment the wrong side starts losing. Here's the part most people miss. The system doesn't panic when price drops. The system panics when price rises and doesn't come back down on schedule. That's when the interventions start. Not the kind that makes headlines. The kind that shows up as routine notices, risk management, technical adjustments, clean language, polite language, language that hides intent. Because if the banks can't win with positioning, they win with structure. They rewrite the rulebook quietly, fast, and always for stability. And once you see that pattern, the day stops feeling random. The timing stops being coincidence. The sudden rule change stops being paperwork. It becomes a move on the board. The villain isn't a person, it's the machine, paper leverage, synthetic supply, and a network that can manufacture pressure without delivering a single ounce. The script's thesis is simple and dangerous. Silver is splitting into two worlds. One is the paper game, priced, hedged, and managed. The other is physical scarcity, metal that must be found, paid for, and delivered. The gap between those two worlds is widening. And every new stability measure is proof the fracture is accelerating. So the question isn't, will silver go up? The question is, what happens when the people who control the rules realize the rules aren't working anymore? If the system really is rewriting the rules, you won't hear it in a press conference. You'll see it in the fine print, quietly, clinically, dressed up as procedure. That's the bridge between the first claim and the first proof. The story stops being a vibe and becomes a document. Because the first hard evidence here isn't a rumor or a dramatic headline. It's an emergency CME advisory that changes the plumbing of the silver market in a way most people won't notice until their position is already on fire. On paper, it looks harmless. Margins stop being a fixed dollar number and become a percentage of notional value, framed around 9%. That wording is doing its job. It sounds technical enough to make you skim. But the moment you translate that sentence into cash, you realize what it really is, a moving clam. Fixed margins are predictable. Notional-based margins rise automatically as price rises, tightening every time silver climbs. In a fast move toward the mid-80s, that change doesn't manage risk, it weaponizes momentum against the long side. The script keeps the math simple for a reason. Once you see the jump per contract, You can't unsee the intent. Thousands more in required collateral can translate into an immediate approximately 15% increase depending on price level, meaning traders don't get a philosophical choice. They get a deadline. Wire more money now, or get sold out. That's the shock headline. Not 9%, not policy update.
We need to cross-reference
the headline is
liquidation
pressure.
The numbers align
delivered
here,
through
but
a
check
rule.
page 3 for the revised
And this
schedule.
is why margin hikes are never neutral in this
Tuesday.
narrative. They don't punish the strongest hands. They punish leverage, anyone long futures without excess cash sitting idle. You can be right on direction and still get crushed by mechanics. Raise the cash requirement, and you force a cascade. Margin calls hit. Positions get trimmed. Forced selling prints red candles that look organic on the chart. Then comes the unsettling pattern match. We've seen this timing before. In past cycles, sudden margin jumps appeared right as silver momentum got dangerous, and the sell-off that followed looked like nature, not design, which leaves the question hanging exactly where the script wants it. If this is routine, why does it keep arriving at the moment the system most needs a reset? Once you understand what the margin change does in theory, you're forced to watch what it does in practice, because the market doesn't debate policy. It reacts. And the reaction is the impact shot the script is waiting for, right after the notice hits. The chart prints a clean, violent move, silver slipping from the mid-$80s down toward the low $80s like someone yanked the floorboards out from under it. To the casual viewer, that looks like a rally failing. To the mainstream headline machine, it's the easiest story in the world. Silver finally breaks. Speculators unwind, risk off. But the narrator frames it differently. And the difference matters. This isn't presented as natural selling. It's presented as mechanical liquidation, the predictable byproduct of a rule that forces cash demands upward in a market built on leverage. Algorithms don't change their mind. They obey constraints. When margins rise, weak hands don't get to be patient, they get margin called. Positions are trimmed, stops are hit, and the sell pressure looks eerily synchronized, like a controlled demolition designed to create one thing: a red candle big enough to scare the crowd and reset momentum. And here's the pivot that makes the segment dangerous. The smash doesn't finish the job. The drop is sharp, yes, but it's not the kind of collapse that rewrites the narrative. It doesn't waterfall. It doesn't cascade into a multi-day washout. Instead, it gets bought fast. The candle bleeds, then stabilizes, then finds bids like the market is waiting for the discount. That's the plot point the script underlines. The old playbook still manufactures fear on the screen, but it no longer produces the outcome it used to, an actual trend reset. So this moment becomes a stress test of the system's power. If margin is the weapon, this was the trigger pull. If leverage shakeouts are the tactic, this was the execution. And yet the result is strangely incomplete, more like a warning shot than a kill shot. Which forces the next question the audience can't unhear. If they fired the weapon and silver didn't truly break, what changed underneath the market that made this play fail? That's the crack in the story, right there in the rebound. If the margin hike was supposed to slam the door on silver, why did the market act like it was invited in? Why did a dip that should have triggered panic get treated like a clearance sale? The script's answer is deceptively simple, and that's what makes it stick. You're no longer watching a single market. You're watching two markets wearing the same price tag. This is the bifurcation thesis. Margin weapons only hurt paper longs, futures, leverage bets, positions that live and die by collateral rules. They're easy to bully because the referee controls their oxygen. Raise the requirement, and you force a pay now or get out moment. But physical buyers don't breathe that air. A manufacturer needing silver for production doesn't get margin called. A fund buying for delivery doesn't get liquidated because an exchange updated a formula. A buyer paying cash doesn't flinch at a rule change, because the rule change isn't written for them. So when the smash hits, it does something counterintuitive. It delivers metal to the wrong audience. The forced sellers are the leverage traders, the ones who can't or won't post more collateral. The buyers waiting underneath are the ones who actually need metal, not exposure. To them, the dip isn't a signal to run. It's a discount. It's inventory offered cheaper for a few hours because someone else got squeezed by mechanics. And that's how the meaning of the margin hike flips. What looks like a demand killer on the chart becomes In this framing, a demand accelerator in the real world, because it transfers ounces from weak paper hands into strong cash hands. That's the whole reframe. Paper gets bullied by rules, physical obeys supply and need. One market is governed by policy and collateral. The other is governed by delivery, procurement, and necessity. And once those two worlds diverge, you get a new kind of price action, red candles that scare traders. But don't break the trend. Because the buyer under the market isn't chasing momentum anymore. They're filling orders. Which leads to the uncomfortable implication. If interventions can still knock price down but can't knock demand out, the next battle won't be fought on the chart. It'll be fought in access, who gets the metal, and who gets shut out.